Good morning and welcome to another Five with Fitz. I'm, of course, Keith Fitz-Gerald. Thank you for watching and for spending a few minutes of your valuable time with me. I know everybody's busy and the world's complicated, but this is great fun. I love having you here. I love the fact that we're together. So anyway, not to get all mushy and stuff, but the media would have you believe that the nvidia trade is reignited AI, right? Well, thing is, it never went away in the first place, folks. At the risk of sounding like a broken record, and very deliberately so on my part, I might add, if you are not investing in the best, you will get left with the rest. No two ways about it. So here's my playbook. In my best band leader voice, a 1 and a 2. I know, bad joke, but keep in the rhythm, and I hope you're in tune. I told you two things Monday during my first TV appearance of the week. A, that nvidia could save the markets, and B, that Walmart was the one to watch. Now, most investors could double their shares in both companies and still not have enough, in my humble opinion. Please watch that video elsewhere on the channel if you'd like, or click on the version written 5 with Fitz. Number 3 today. Yes, because remember, we did a 1 and a 2. Number 3 today. Hyperscale debt equals doom? Really? Only if you flunked Econ 101. Now, let's get serious for a second. nvidia definitely sent them packing, right? Yet, the bubble babblers just can't give up. This morning, now they're saying that the real AI bubble indicator isn't nvidia's results at all, like they've insisted for the past 5 weeks. It is the debt behind data center build-out. Well, apparently because, as they wag their finger in your face, which really happened to me in a grocery store line the other day, hyperscalers are using debt to expand capacity, and that means the whole AI boom is on borrowed time. Pun absolutely intended. Really? Even well-known investor Ray Dalio jumped in yesterday saying we're, quote, definitely in a bubble, right before he admitted that you shouldn't sell yet because nothing is actually popping it. I mean, man, this stuff makes my brain explode. You can't make it up. Here's what I want you to keep in mind. If NVIDIA's results show anything, they show that we are still seriously early in a multi-year, probably multi-decade build-out, and that there is unprecedented profit potential on offer. Not late, not peaking, early. There is an entirely new generation of millionaires being printed right now. But hey, it's a free country. If you want to buy something else because valuations look better, something I hear a lot, knock yourself out. And be prepared to come to terms with folks who make different choices that come with a radically different and potentially far more profitable outcome in the years ahead. Just saying. All right, here's an investment tip in this department because I don't want to belittle this, right? I mean, it's scary. It's different. I get it. That's how change works. But here's the thing. Bubble babblers are simply perma bears with better haircuts. They're loud, they're certain, and they're usually wrong at precisely the moment it matters most. Now, both of those groups, the perma bears and the bubble babblers, thrive on fear because fear sells. It makes you think that you're thinking about something wrongly or they're looking around the corner and seeing something you're not. But neither group, neither behavior trait, neither behavior set builds wealth over time. Sure, they sound smart, but predicting 284.7 of the last 2 actual downturns doesn't count for a whole lot in the scheme of things. And it's very dangerous for your money to follow along with them. Now, eventually, of course, they're right, and they won't hesitate to let you know it, but so's a busted clock twice a day. The real money comes from staying data-driven, keeping your emotions out of the equation, and buying the very best companies you can while everybody else is hyperventilating. Now, history shows very clearly that their panic and pontificating, by the way, is almost always a great entry point for those who want to build real wealth and keep it. So please take a look at the chart in the written version of 5 with Fitz today. I think you'll see what I mean. It's not rocket science, folks. All right, number 4 today. Are these Fed minutes or a comedy special? It's hard to tell these days. The latest Fed minutes show that officials were, quote, deeply divided over last month's rate cut, right? Some apparently argue, Fed committee members argue that the labor market is weakening, while others insist that inflation is still too hot. Well, the result? Yeah. A growing chunk of the committee now thinks no additional cuts are needed this year, including December. Traders, of course, have adjusted fast. The December cut that looked like a lock a few weeks ago is now about 1 in 3 with January on deck, so to speak. This is a classic Fed move. Uncertainty first, clarity later. Not for nothing, I told you on October 9th during an appearance on Maria Bartiromo's show that I wouldn't be surprised if the Fed didn't cut. So let that sink in. And just in case things aren't spicy enough, oh man, U.S. President Donald Trump put another shot across Chairman Powell's bow, saying he'd love to fire his boop, and urging Treasury Secretary Scott Bessent to work on Powell to lower rates. I mean, this reminds me of an issue of an episode of The Sopranos at this point. You know, my POV is simple. The Fed still has no idea whether it's fighting inflation, saving jobs, or just trying to stay relevant. One minute they're doves, and next minute they're hawks, and half the time they sound like a flock of pigeons arguing over breadcrumbs. Powell says that they're driving in the fog, but I don't think it's dawned on Powell and his bunch that perhaps they're the ones who created the fog in the first place. Just saying. All right, Keith's investing tip. Getting around this is not difficult. You want to buy the very best companies you can, meaning those making must-have products and services with fortress-like balance sheets, defensible margins, and excellent leadership capable of succeeding practically no matter what the Fed does next. Names like the one bar ahead family knows well. All right, number 5 today, Denmark, now brought to you by Novo Nordisk. Here's something you don't see every day. Denmark has just posted its fastest economic growth in years, and it's thanks entirely almost to one company exclusively, Novo Nordisk. Now, GDP jumped 2.3% in Q3, the biggest quarterly gain since 2021. Now, take out pharma, and the economy would have grown just 7.7%, nearly 70% less. That's astonishing. I can only recall a handful of times in my career that I've seen one company's sales curve take over the national GDP chart. So the question on the minds of many today is, should you buy Novo Nordisk, right? Now, I could absolutely make the argument that the answer is yes. Novo is down 49% this year, give or take, yet it's single-handedly powering Denmark's fastest GDP growth in years. GLP-1s are becoming infrastructure inside of healthcare systems around the world. I mean, it could be one heck of a buy, no two ways about it. But I, given the way I look at things, can think of a few other names I'd rather own. My personal favorites remain those with far more dominant positions, and here's why I say that. As good as it is, as good as the company is, as good as the products they make are, GLP-1s are an at-risk technology. And Novo Nordisk, in my opinion, is but one innovation from somebody else inventing something away from losing everything. What investors are missing is very simple in my world. Novo isn't just competing against Eli Lilly or another drug company like many investors think or the media would have you believe. No, in my view, the company is competing against every lab, every AI drug platform, every metabolic moonshot chasing the next breakthrough that leapfrogs injectables entirely. Now, oral GLP-1s, gene edits, next-gen metabolic modulators, even AI-designed compounds targeting obesity from completely different biological angles. And that's not, by the way, even counting real exercise or diet management, which, contrary to what the easy button crowd wants you to believe, actually goes a long way. Now, don't get me wrong, serious and real healthcare concerns are different, so that's not a dig in any way, shape, or form. The point I want to make is that if any one of those things hit, Novo's dominance can go from fortress to free fall in a real hurry. So Keith's investing tip in this department is very straightforward. Great companies can still be terrible trades and investments when the innovation risk is rising. That's why I prefer to own the players building platforms, not products, because the platforms these days are what capture the upside practically no matter who makes the next big breakthrough or what it actually is. Today's bottom line, one that hits hard today because there's a lot of people getting left on the platform. Pessimists have a hard time making money, so be an optimist. Life is more pleasant and profits become a lot more consistent. As always, let's make it a great day. Thanks for watching. You got this, I promise, and I'm with you every step of the way. I'll see you tomorrow. Cheers.